On Business Incorporated today, African Airlines record highest international cargo volumes in September, the largest increase of all regions for the 9th consecutive month. And Boeing to compensate victims in Ethiopian Airlines 737 MAX crash. ESCOM downgrades load shedding to stage 2 and will suspend it on Friday. Hello and welcome to the program. I'm Chimeze Obi Iwago. We start off with major equities on the African continent where trading activities were mostly positive at intraday. Nigeria's benchmark index traded with negative sentiments at intraday down 0.16%, while South Africa's JSE index rose significantly by more than 1%. Similarly, Egypt's EGX30 saw positive movements at intraday as index climbed by 0.41%. The Nairobi Stock Exchange closed Wednesday's trading session also in the green. Over to the Middle East now, where investor sentiments were bullish at intraday. The Abu Dhabi index inched higher by 0.35% rather, while Dubai's main index jumped by 1.03% at intraday. Elsewhere in the region, Saudi Arabia's main index edged up by 0.3%, while the Qatari index also traded in positive territory, up by 0.85%. And European stocks were flat in the morning as global markets digested the latest U.S. inflation data, which showed a faster than expected price rises. For more, let's bring in Chelsea now. Hello, Chelsea. Good afternoon. Well, investors are gearing up for higher inflation after the world's 4 largest economies all reported near record price growth in recent days. Do investors in Frankfurt see this as a serious threat?
Yeah, it's interesting because these have been really explosive inflation reports, and we're getting them from all major economies right now. So here in Germany, we also saw inflation running at the highest rate since the early 90s, the same in the US, Japan, China reporting very significant price increases for factories and for producers. But investors are really calm right now. Today we have the DAX up just a tiny amount, about 0.1%. Yesterday we had seen US stocks fall after that data, but they do seem to be turning more optimistic once again. So investors, I think, are looking at this data. They obviously see it as a concern because consumers, businesses will feel this no matter what, but they do still believe that it will be temporary. And we actually heard from the European Central Bank earlier today that they think by 2023 inflation is going to be back below their goal of 2%. So I take this message from markets as saying, yes, we see inflation rising, but we still think it's going to be temporary, and that means central banks won't have to move very aggressively, as some had feared, to contain inflation.
And Germany's top economic advisory panel has cut its expectations for growth in Europe's largest economy. What are they now expecting?
So they now are expecting the German economy to grow at a rate of about 2.7% this year. Previously, they had been expecting 3.1% growth, so it is a moderate downgrade. But we've seen this across pretty much every major economic think tank, economic institution. All are starting to grow more pessimistic on the German economy. And just to put that in comparison, the broader Eurozone economy is expected to grow at about 5% this year. So Germany is definitely going to be one of the laggards. We've talked about the problems the German economy is facing, but just to sum them up, it's things like supply chain disruptions that are making it very difficult for factories here. Germany is still a very factory and an industrial dependent economy. As well, we are starting to see here in Germany quite a significant surge in coronavirus infections. We've been setting record after record every day, and that is raising concerns once again that we, heading into the winter, might have to see further restrictions that could also constrain the economy.
And shares of German chemicals company Merck slid after it released third quarter earnings. Why the big disappointment?
Yeah, it's interesting because in general, this report was better than investors had been expecting, but they are finding some reasons for negativity here. Merck, which is a German company, not the U.S. pharmaceutical giant Merck, there are two of them. It's a bit confusing, but the German Merck is also a pharmaceutical provider. They provide chemicals. They have a lot of different businesses. In this quarter, they did see their profits decline, which may be one of the reasons for disappointments here. But overall, they do still see their businesses growing quite strongly. So one of their core businesses has been supplying a lot of vaccine makers with different pharmaceutical products, and that business has been growing very, very strongly. With sales were up about almost 30% in this quarter because of the pandemic. So that's something that's really been helping the overall company. The other big driver for Merck is that they have a semiconductor businesses. We know right now semiconductors are an extremely hot market, very much in demand. So that business has also been doing pretty well over the past couple of quarters, but it hasn't been enough to impress investors, and we have seen the stock fall about 1% here in trading in Frankfurt.
All right, thank you very much, Chelsea, for those updates this intraday. Enjoy the rest of the day. And in the UK, today's GDP report shows that the UK economy is lagging behind G7 rivals in recovering from the pandemic. Juliana has more to tell us. Hello, Juliana. Good afternoon. Well, we'll kick out from the data front. The recovery in the UK has fallen a little behind that in the EU. Again, looking ahead, the economic recovery in the EU is losing momentum and COVID cases there are rising. So is there hope the UK should catch up in the fourth quarter?
Good afternoon, Chimmy. Well, there's hope, but it's not looking great. As you said, Britain is lagging behind its G7 counterparts. In fact, the 2.2% where we are now in terms of being 2.2% smaller than where we were pre-COVID crisis, the final quarter of 2019. It's only Spain that's doing far worse than us. The US, of course, are already past their pandemic slump. I believe France, Germany and Italy are all about 1.4 to 1.5% behind. And then we've got us with this 2.1%. GDP Q3 data came in from the Office for National Statistics earlier today, showing that in the months between July and September, growth was at a very sluggard 1.3%. And this compares to 5.5% recorded in Q2. There are several reasons. Mainly it's because of this supply chain restraints. Car production slumped. Many car factories up and down the country had to halt production because they just couldn't get their hands on these semiconductor chips. Also, manufacturers were finding it pretty difficult to get some goods. Same within the retail sector. Also, as well, a lot of consumers are losing confidence. People are not really spending as much as they were beforehand. We've had consecutive months of dips in retail sales figures. However, September on its own did show a slight rise. It came in at 0.6%. Some estimates were at 0.4%. So, you know, we're hoping, or the economists are hoping, certainly Chancellor Rishi Sunak is hoping, that the golden quarter, the fourth quarter, will finally gain some strength. But it's not looking great. We know inflation is at 3.1%. Energy prices are high. Lots of these companies are now starting to trickle it down to the consumer. And if the consumer starts feeling the pinch in the pocket, then they're not going to spend their pounds at the checkout.
Absolutely. But how are the markets reacting to these latest GDP numbers?
Well, the pound certainly fell against the dollar. That was a strong reaction. But the markets are actually doing not bad at intraday. I think this is because of the miners. There's a surge in demand for commodities at the moment. So all of the big titans are lifting up the FTSE 100 at intraday. The all share is up 0.42%. The FTSE 100, that's up by 0.40%. And the FTSE 250 also up at 0.36%. In the currencies market, the British pound is down on the US dollar by 0.14% following that GDP data. The pound is currently flat against the euro, and the currency is trading down against the Japanese yen by 0.04%.
Meanwhile, global markets began the day digesting the latest U.S. inflation data released on Wednesday, which showed that October's consumer price reading jumped at the hottest annual pace in more than 3 decades. Is that also a topic of discussion where you are?
Absolutely, it is, Chimase. I think, inflation is a significant topic of discussion as we go into the all-important festive period. As I said, it seems to be one of the main reasons why consumers appear to be holding back at the checkout. Lots of people are starting to feel the pinch. And of course, when inflation rises, your wages stagnate. What your money was worth this time last month is not what it's worth at the moment. I think there was a shock from markets when yesterday's data came in, I believe, at 6.1% from Washington. All of the markets were down overnight, although I did get a glimpse before I came into the studio. It does appear that the Dow Jones has opened in positive territory. But, inflation is pretty important. So some economists are still anticipating that perhaps there may be an interest rate rise in December on the 6th when the Bank of England Monetary Policy Committee gather once again.
All right. Thank you very much, Juliana. Do enjoy the rest of the day.
Thanks, Jimmy. You too.
And in Asia, stocks were mixed today after data released overnight showed U.S. consumer inflation spiked in October. Shares of China Evergrande Group listed in Hong Kong surged 5.49% following a report from Chinese media outlet that several bondholders received coupon payments from the debt reading developer. However, Hong Kong's broader Hang Seng index dipped 0.15%. Mainland Chinese stocks were higher, with the Shanghai Composite up 0.59%, while the Shenzhen component gained 0.85%. 9%. Australian stocks declined as the S&P ASX 200 fell 0.63%. The Nikkei 225 in Japan rose 0.5%, while the Topix index gained 0.27%. South Korea's Kospi shed 0.68%. And the U.S. stock futures were little changed in early morning trading following a tech-driven sell-off on Wall Street. Dow futures rose just 4 points. S&P 500 futures and Nasdaq 100 futures both hovered in mildly positive territory. The major averages dipped on Wednesday after a hot inflation report pushed up bond yields. The rise in yields especially pressured growth pockets of the market. Dow Jones Industrial Average lost 240 points, dragged down by roughly 3% losses in Salesforce and Nike. The S&P 500 fell 0.8%. The Nasdaq Composite was the relative underperformer, dipping 1.7%. Persistent inflation data was released on Wednesday. The Consumer Price Index, which is a basket of products ranging from gasoline and healthcare to grocery and rents, rose 6.2% in October from a year ago, hitting its highest level in 3 decades. On a monthly basis, the CPI increased 0.9% against the 0.6% estimate. And oil prices were steady in early trade after falling in the previous session on concerns rising inflation in the United States spurred by climbing energy costs may prompt the government to release more strategic crude stockpiles to drive down prices. On Wednesday, Brent crude futures fell by 2.5% and West Texas Intermediate futures dropped by 3.3% after reports that U.S. inflation increased at the fastest rate in 30 years, pushed the dollar higher, and crude inventories in the U.S., the world's biggest oil consumer, rose after the government released some strategic reserves. Brent crude futures gained 18 cents to $82.82 a barrel this morning, while WTI futures rose 17 cents to $81.51. And on the metals market, gold prices were flat in early trade after a surge in U.S. consumer prices drove the metal, seen as an inflation hedge, to a 5-month peak in the previous session. Spot gold was little changed at $1,850 per ounce after hitting its highest since June 15 on Wednesday. U.S. gold futures gained 0.2% to $1,852. Gold is often viewed as a hedge against rising price levels. In other metals, spot silver rose 0.2% to $24.68 per ounce. Platinum was up 0.1% to $1,068, while palladium gained 0.5% to $2,031.70. After the break, Boeing to compensate the 157 people killed in the 2019 Ethiopian Airlines 737 MAX crash. This plus more on commodities market update and other developments in Africa. Do stay with us. And Boeing has acknowledged liability for compensatory damages in lawsuits filed by families of the 157 people killed in the 2019 Ethiopian Airlines 737 MAX crash. As a result of the agreement between Boeing and the families, lawyers for the victims will not seek punitive damages, and Boeing will not challenge the lawsuits being filed in Illinois. Lawyers for the victims noted in a statement that Boeing admitted under the agreement that the 737 MAX had an unsafe condition and that it will not attempt to blame anyone else for the crash. Boeing's best-selling plane was grounded for 20 months after 346 people died in two 737 MAX crashes in Indonesia in 2018 and in Ethiopia in 2019. The plane returned to service after Boeing made significant software and training improvements. The crashes already have cost Boeing some $20 billion. And Africa witnessed the highest growth in international freight cargo volumes in September compared to any other region in the world as the airlines continue recovery from the impact of COVID-19. Data from the International Air Transport Association indicates that Africa recorded a 34.6% growth in the review period to mark a ninth consecutive increase on month. The volumes, according to IATA, are 20% above the pre-crisis 2019 levels, but have been trending sideways for the past 6 months. Total demand for air travel in September 2021 was down 53.4% compared to September 2019. The agency says continuing border closures and quarantine mandates are impacting negatively on travel. And more on commodities market here. High price for the liquefied petroleum gas, otherwise known as cooking gas, may cloud Nigeria's journey to net zero as many Nigerians are resorting to wood and charcoal for cooking. Today on Commodities Market Update, we will be talking about charcoal and the implications of the change in demand pattern. Lawrence Messi, research analyst with financial derivatives company, will take us through that. Hello, Lawrence. Good afternoon. Well, Nigerians are experiencing a consumption shift from cooking gas to alternative sources like charcoal and kerosene. What are the implications of this change in demand pattern, considering that the focus of the world's leadership is centered at sustainability and climate change?
Good morning. It's great to be here. I'd like to approach this under two main factors. The first being the economic and the second being the environmental. So under the economic, the increased demand in charcoal will inevitably result in an increase in price of charcoal. And as you've seen, the price of charcoal has actually increased by almost 100% from about 1,500 to about 2,500, 3,000. And then the second economic factor would be the effect it will have overall on inflation figures, even though we've seen inflation figures fall consecutively for the past 3-4 months. We could see a negating trend if these LPG and charcoal prices continue. Now, under the environmental factors, basically, this is going to have an interactive joint effect on climate. First is the fact that coal is the largest emitter of CO2 and greenhouse gases amongst other fossil fuels. That's one. So the increased usage in charcoal will only just increase Nigeria's emission of greenhouse gases. And the second thing is that due to increased demand for charcoal, there would be increased felling of trees and increased burning of woods, which would only add to deforestation. And deforestation is one of the primary factors aiding in Nigeria's inability to meet its sustainability goal. So we have continued CO2 emissions and then deforestation, which now exposes us to the harshness of climate change.
you mentioned, the price of a bag of charcoal has doubled over the past year from 1,500 to about 3,000, and quantities sold in some regions have also increased by almost 400%. This all but shows the cross elasticity between LPG and charcoal. What is the outlook for demand for charcoal, and are there any alternatives to the usage of charcoal?
Well, the alternatives to charcoal are mainly LPG and kerosene. And LPG prices, as we've seen, have been rising since the last year. And kerosene is not exempt from this. Kerosene has also actually been rising quite fast. And most of the domestic kerosene stoves have only a capacity of 3 liters, and kerosene is currently at about 400 naira per liter. So it's not even quite sustainable for households. So these other two substitutes are increasing in price, which leaves charcoal as the cheapest alternative. And in terms of the outlook for demand, well, LPG prices have been rising because of a couple of factors, which are the VAT increase to 7.5, the devaluation of the naira. Why this is important is because Nigeria actually imports about 60% of all its LPG. It's not able to meet demand locally. And so the devaluation has increased the landing cost and the final selling cost to consumers. So when you look at all of this, until these factors themselves reverse, then I don't really see any reversal in the demand patterns for charcoal in the near future.
Now, 5 African leaders spoke at the COP26 conference on climate change, where they highlighted the need for developed nations to fulfill their climate finance and promises to Africa. This switch in demand to charcoal in Nigeria negates the stance of the government in relation to reducing greenhouse gas emissions and being environmentally sustainable, considering that Gabon has already experienced financial benefits and international recognition for being environmentally sustainable. What can Nigeria do at this juncture to limit this trend in charcoal consumption?
I feel like a two-step approach would be feasible, and this would be education and collaboration. So under education, it would be important for them to educate a lot of the mass on the dangers of excessive use of charcoal and its impact on the environment, because as we know, a majority of the rural population are those who actually use charcoal for cooking instead of LPG. So education would be the first step, which would be to get them on board and to also build up the demand for LPG. And then the second step being collaboration, which I would suggest we have a two-phased approach, and that would center around restructuring the overall oil and gas industry to maximize extraction of LPG. And then the second being invitation in order to develop an investment-friendly environment for more private investors into the LPG, because as we've seen, NLNG is actually the sole producer, size itinerary domestic producers of LPG, and they account for only 40%. The balance of 60% is met by imports. So we need to eliminate those imports by bringing in more private investment to the sector, so as to ensure that local demand is satisfied locally through production. I believe that with this, there would be an adequate phasing out of charcoal and promotion of the use of LPG.
All right, thank you very much for your time, Lawrence. We do appreciate it.
Thank you.
And South Africa's power utility Eskom has downgraded load shedding from stage 3 to stage 2, and that took effect today at noon. It also announced that the load shedding will be suspended from 5 a.m. on Friday. The country has been gripped by an energy crisis for more than a decade, with various boards and CEOs at the state-owned entity having failed to resolve it. The power utility has been battling infrastructure problems since the Democratic government inherited it. On Monday, ESCOM said it would implement Stage 4 power cuts from 1 p.m. on Monday through to 5 a.m. on Friday due to generation capacity shortages. Stage 2 power cuts will then be implemented until further notice. ESCOM said it managed to recover 2,000 megawatts in partial load losses from when it implemented Stage 4 load shedding. And that's it on the program. Thank you for watching. I'm Chimeze Obi Iwago.